Hello and welcome back. In the previous sections, we learned in details about the assets, their components, their valuation, and the details and where we need to be careful while looking at those assets. In this section, we will be looking at equity and liabilities. Now, equity, as you can see, equity share capital is pretty much is easy to see because it's the investment that owners has made it, or the shareholders own this money. Other equity, and now here let's go to the schedules as well so that we can see in details what are those. Okay, here. So equity share capital, this is the statement of changes in equity. Is basically the same as the schedules that we are going to see in future now in a bit now. So here it says how much shares are outstanding, how much share capital is outstanding, how many was issued in the during the time, and how many is the closing balance. And other equity also is showing the movement, what was the beginning, and then how much income we had during this year, how much earnings, and then how much is the closing balance in this end of the financial year. This is other equities, mostly on the reserves, advanced share capital, capital reserves, or other security premium reserve. We will not go into the detail again of these terms because these are not really important for everybody. These are certain every company has their own different. For example, just now we can look at Apple balance sheet. Here the shareholders equity and their only retained earnings. That's it. There is nothing much more complicated here. We can look at the statement of changes in equity here. So you can see common stock capital, then there are some repayments, and then there are retained earnings, and then there are other accumulated earnings. So that becomes to the total shareholders equity. Not so complicated. Now in Apple, here you can see they are repurchasing some of their own shares out of probably the bonus, so that they are reducing the share capital base to increase the value of the remaining shareholders. Now here you can see they have been purchasing over years, coming again every year they purchase some of the repurchase of common stock, reducing the value of the shareholding equity, so that it's actually increase the value of the remaining shareholders. It's a one way of the increasing the value of the remaining shareholders. We will not go into too much detail of these things because those are not really a general purpose financial statements things. Now we go to the schedule number 13. Just hang on a while we reach there. These were the assets, investments, number 6, number 15. Okay, here number 13. So here you can see the share capital, authorized share capital of this company is 14,000 crores. Preference shares, this is only share cap authorized, it's not real one. Okay, the real one is here. Issued, paid up, and subscribed. So previous year it was 3251, this year is 6331. And how it becomes increase, here you can see what happened during the year, that why it was increased. So here are the details of some major shareholders which are having more than 5% shares in the company, or so these are again only a stock exchange listing requirements. These are not necessarily details that has to be shown in the financial statements. Now reconciliation is here. You can see here that in the previous year they had total of 3,203 billion shares. This year they added bonus shares. So the bonus shares are usually issued out of profits. So this year they have given the bonus share. That's why the share capital increased from 3,000 to 6,000. Now these details are about the reserves. So in the financial statements, normally the requirements from financial reporting standards is we need to show a change, how the shareholders equity has changed during the year. What was the beginning of the year? What changes happened during the year? How many shares we issued? How many shares we repurchased? How many bonus shares we issued to them? And then also the reserves, how we adjusted the reserves, basically just to give the shareholders an idea how their money is being utilized. So beginning of the year, then you have usually you have new reserves, new profits, new reserves created out of profits, new shares issued, new bonus shares. You see here, you can say that out of this share security premium reserve, they issue the bonus shares, which we saw as addition in the previous share capital. This is how they need to show the movement in the reserves, in the equity, whatever is the equity. Now that was shareholders and equity. The next line is about the borrowings. Borrowings here you see is they separate into secured and unsecured borrowings at amortized cost. So they are non-convertible debentures. Secured means they are the company has given certain amount as a collateral to convert to secure the redemption of these debentures, or to secure the repayments. Unsecured means we have not given any kind of security. So if we are at the end of, let's say, God forbid, the company closed down now, these holders will have no rights over the assets of the company to recover their investments. Of course, the liquidator will put them in the last. So the first right will be from the secured, second right will be of the employees, and then they will come in the last if there are assets still. So how we secure them? Here is the secured, is the details of how we secured, what kind of assets did we mortgage here. So this information is pretty important for person who is buying the assets. So if you look at the assets and financial statements, and if you see this particular property, Hazaria complex and Jamnanagar complex, is mortgaged for these, they wouldn't really buy, or they wouldn't really deal with this asset anymore. So this is to safeguard the general interest of the public. Now this was 15. Here then we move on to the other. Now there are more details on this one. What are the rate of interest, what are the period of when they gonna be matured, so that you can understand the future cash flows. These are required by most of the international financial reporting standards, and also the stock exchanges listing requirements, because this company is listed, is one of the biggest companies in India. So the stock exchange usually requires them to give more details to the users, so that users can understand. Now let's look at the next line, where we have provisions. So provisions, these are non-current provisions, means this is the provision for decommissioning of assets. Now decommissioning of assets means the company has plants where they have a liability towards the government to decommission it and clear the site. So they have made a provision now already, so that in future they can use this. Now here you can see the movement in the provision is towards utilization of TAPTI facilities, change in the exchange rates, unwinding of discount or provision of the various blocks, because the provision is made based on the discounting factors, based on the interest rate, because they are not going to decommission this now, they are going to decommission in future. So how much the future value will be, they have discounted at this current exchange rates, current interest rate, and put the net present value of those future cash outflows, and that has been added to the cost of assets, for your information. Next line will be deferred tax liabilities. Deferred tax is usually, if you don't know already, deferred tax means the company has a tax liability based on their profits now, but however, due to certain tax exemptions or accounting adjustments which the tax is giving them, or difference in exchange rate, or difference in depreciation rates, the company is able to postpone the tax liability to future years. So that's how what is the deferred tax liabilities. The deferred tax here they are giving the details of what are the deferred tax liabilities in relation to. The deferred tax liabilities in this particular case mostly is coming from the depreciation, property, plant and equipments. So it's mostly because of the changes different in the accounting depreciation rates and the tax depreciation rates. Sometimes government, to boost the investment, they provide accelerated rate of depreciation while the accounting depreciation remains the same. So that gives a rise to a lower tax liability as compared to the book profits. So that's give rise to the deferred tax liabilities. That's a very short explanation for that. If you want to know in details, please write down. I will post another video for explaining more details about the deferred tax liabilities. Now the next line here is other non-current assets, advance from related parties. So they have taken some advance. In the previous videos we saw this company has been giving advances to their related parties. In this particular case, they have taken some advance from the related parties. So these were all the non-current assets. We have non-current liabilities which are not going to be settled within 12 months, coming 12 months. Now we are looking at the current liabilities. So the company has borrowings, secured borrowings, which they expect to repay within 12 months. Rupee loan, foreign currency loans from banks, and some unsecured loans from the banks and from others, means commercial papers. Now what is commercial paper means? They have launched a commercial paper to get loans from the public or from the financial institutions. So how they use this commercial paper, there's no detail about that in the financial statements. The most information you can get it from the cash flow statements, which we'll be looking in the next section. Other part of the current liabilities are trade payables. The company is owing a lot of money, $88,000 to its suppliers. Out of that is the stock exchange. The Companies Act or the Micro, Small, Medium Act in India requires companies to disclose separately how much they owe to the medium and small medium enterprises, so that just to make sure that they are not manipulating or holding a lot of money from those small companies. Otherwise their credit is tied up and they are not able to grow their businesses. Other current assets are these other financial assets, financial liabilities, which are current. So current maturities of borrowings. So they have taken some loans or some borrowings, so means which are current. They were non-current in previous, but now the maturity has come within 12 months, so it has been classified from non-current to current. Interest accrued on those borrowings, unclaimed dividends, application money, other payables. Now other payables are, what are the other payables? 26,000 includes creditors of capital expenditure, security deposit, and financial liabilities at fair value. So you need, as a user of financial statements, you need to be able to see a detail of these money, because this is quite significant compared to the other numbers. So here the financial statements would not give more than these details, unfortunately. Now the next line is the other current liabilities and other provisions for employee benefits, for other provisions. So these are, but there are not really a lot of details available in the financial statements, because the companies are not required to disclose too much details. But if you are reviewing the financial statements, if you are buying these companies, if you are interested to know more, you can ask the company directly what are those, and evaluate, are they real assets or are they real liabilities, or the company is just making up those to mislead the users. Okay, these were all about the assets and liabilities. In the next video we will be looking at more some of the common concerns in the balance sheet and assets and liabilities. Stay tuned. Thank you very much.